So, welcome everyone to the London School of Economics and the Political Science for this hybrid event. My name is Dimitri Vayanos, and I'm Professor of Finance in the Department of Finance and co-director of the Financial Markets Group at the London School of Economics. I'm very pleased to welcome both our online audience and our in-person audience here at the Sheikh Zayed Theatre. Today we will hear the inaugural lecture of the Sir Oliver Hart lecture series. I'm very pleased that this inaugural lecture involves two great economists and who are also very dear to me, Sir Oliver Hart and Luigi Zingales. Sir Oliver Hart is currently the Louis P. and Linda L. Geiser University Professor at Harvard University, where he has taught since 1993. He won the Nobel Prize in Economics in 2016, joined with MIT professor Bengt Holmström for their path-breaking work in the economics of contracts. Sir Oliver has done foundational and extremely influential research on incomplete contracts and the theory of the firm. His seminal papers with LSE professor John Moore and former UPenn professor Sandy Grossman helped economists understand what a firm is in the first place, what the firm boundaries are, why firms merge or divest, etc. Sir Oliver has also done foundational research with the same co-authors, and more recently with the University of Chicago professor Luigi Zingales, our speaker this evening, on corporate finance, capital structure, and corporate governance. This research led to deep insights on the role of debt in firms' capital structure, the design of bankruptcy mechanisms, the efficiency of takeover mechanisms, the congruence between shareholders' preference and firm actions, and more recently and relatedly, the social responsibility of firms, which is the topic of today's lecture. Sir Oliver is a fellow of the Econometric Society, the American Academy of Arts and Sciences, the British Academy, and the American Finance Association, a member of the National Academy of Science, a distinguished fellow of the American Economic Association, and has several honorary degrees. He has been president of the American Law and Economics Association and the vice president of the American Economic Association. He was made a Knight Bachelor in the King's Birthday Honours List 2023. At a personal level, I'm delighted to be introducing Sir Oliver and the inaugural lecture, as Sir Oliver was one of my professors during my PhD studies at MIT. I was fortunate because that was the time where many of his path-breaking contributions were developed, so our PhD courses, taught by him and others, were reflecting these then new ideas and advances and open new horizons to us. So I will let Sir Oliver say a few words about the lecture series.
Well, thank you very much, Dimitri, for that very nice introduction. Welcome, everybody. It's great to see so many people here, and it's lovely to see many friends. When Simeon Byankov phoned me to say that the Financial Markets Group was thinking of naming a lecture series for me, I nearly fell out of my chair. I remember gasping, "Don't you have to be dead for that?" But fortunately the answer was no, and that's why I'm here today. I'm deeply grateful to the LSE for doing this. It's a huge honor, and you know, it's just absolutely fantastic. I want to thank them. I want to thank Simeon and Dimitri for making the thing come to fruition. Dimitri has also put in a huge amount of work to arrange not only this event, but the conference tomorrow. And so thank you so much for that. I'm also thrilled that the first lecture will be given by my great friend and great co-author, Luigi Zingales. I have a vague idea about what he's going to talk about, and I'm looking forward to hearing the details. So thank you very much.
So I next introduce the speaker of the inaugural lecture. Professor Luigi Zingales is the Robert C. McCormack Distinguished Service Professor of Entrepreneurship and Finance at the University of Chicago's Booth School. Luigi has been an extremely influential economist and thinker. He has done foundational work on the role of finance for growth and economic development, on the effects of culture and trust for the development of financial markets and the real economy, on the determination of firms' capital structure, on the efficiency of takeovers, on political economy and the capture of the policy process by interest groups, and more recently, on the social responsibility of firms, which is the topic of today's lecture. His research earned him the 2003 Bernasser Prize for the best young European financial economist. Luigi served as president of the American Finance Association in 2014. Luigi has been interested not only in producing highly relevant and impactful research, but in bringing his research to change and improve the world. He has co-developed the Financial Trust Index, which is designed to monitor the level of trust that Americans have toward their financial system. He has written 2 highly influential books, Saving Capitalism from Capitalists, co-written with his colleague at the University of Chicago, Raghu Rajan, and The Capitalism for the People, Recapturing the Lost Genius of American Prosperity. Both books emphasize the benefits of the capitalist system as well as its fragility. While open and free markets are a powerful device for generating growth and wealth, the system can become captured and subverted by interest groups. On a related note, Luigi became in 2015 the director of the Stigler Center at the University of Chicago and has refocused on promoting and diffusing research on regulatory capture and the various distortions that special interest groups impose on capitalism. So, at a personal level, I'm delighted to be introducing Luigi, as he was one of my PhD classmates at MIT and a dear friend since then. I have learned a lot from talking to Luigi about economics, especially for understanding financial markets and corporations into the bigger picture where economics and politics intersect. Luigi's lecture today is entitled Reforming Capitalism. Luigi will speak to us for approximately 40 minutes, after which we will be taking questions from the in-person and the online audience. Okay, so a few more administrative items. So for Twitter users in the audience, the hashtag for today's event is it's there. So hashtag LSE Hart Lecture. This evening's event is being recorded and will hopefully be made available as a podcast and video, subject to no technical difficulties. We have also a photographer here to capture the event, and the selection of photos will be made available on our website at the FMG. If for any reason you do not want to be in the images which may be published, please do let us know after the event. Last but not least, there is no fire drill scheduled for today. If you hear the alarm, please leave the building via the market exits. So I spoke enough, so it's a great pleasure to have Luigi deliver the inaugural Sir Oliver Hart lecture.
So it's really a pleasure and an honor to be here. First, Dimitri, thank you very much for the introduction. I think that I learn as much from you than I learned from all the other professors I had. So I think it was a pleasure to have you introduced here. And it's particular honor to be the first one to give the inaugural Sir Oliver Hart lecture series. Sir Oliver is not only a superb economist, as a dramatic rigor in the way he approached economics that I find it even more remarkable than his very remarkable contribution to economics. I think that he has an intellectual honesty in dealing with all the problems, which is really unique. And in addition to that, he's also a phenomenal human being. He's a great husband, a great father, great friend to me and to many people. And so it's really a pleasure, this. And before I start, actually, let not forget Lady Hart, is that the proper way to put it, who has been a big part in Oliver's life and in also his work. So with this preamble, let me try to see whether this works. And I have the privilege also to present some joint work with Sir Oliver Hart. And I think that's a bar, and my hope is that for the 25th anniversary of this lecture series, there will be Oliver here in the audience with some younger person co-authoring a piece. And knowing Oliver's longevity, the family, and his intellectual ability, I have no doubt that this would be the case. So I just hope to be here in 25 years to celebrate that. Anyway, this said, let's actually become a little bit more somber, because I want to start with one of the many tragedies we see in the world. This is one I know particularly well because it happened in Italy, but there are many others that happen all over the world. And this is, if you never heard, this is a large bridge, a very long bridge that collapsed 5 years ago near Genova. And this is actually a picture of the moment the bridge collapsed. It was taken by a camera nearby. And if you can see, it starts to collapse on the tip of a pillar. And then 43 people die, and actually we're lucky we're only 43 because it was a rainy day and not a lot of people were going to the beach that day because it was the middle of the summer. Otherwise the tragedy would be much, much bigger. Now, of course, you can think about this as, oh, this is simply an act of God, and as Americans say, as happens, and who is responsible, etc. The reality is there's been an investigation, and initially they said that there was a lightning that hit the pillar, and that's not the case. So that they went through all the stuff, and basically, the conclusion of this is that there was under maintenance. Okay, so the bridge, when it was built, was very innovative for the time. It was built actually in 1967, and you know the life expectancy of a bridge is 50 years, and it collapsed in 2018, so it was 1 year past the due date. But what is more interesting was an innovative bridge that was trying to cover the cable that sustained the bridge with concrete, because at the time they thought that concrete was really perfect and will not let the salt from the sea corrode the cables. But in 1993, they realized it was not the case. In fact, the designer, Morandi, before he passed away, warned that the bridge would not last very long. So in 1993, they fixed 2 out of the 3 pillars of this bridge. They left the number 3 still pending, and from 93 onward, there was no maintenance, and surprise, surprise, in 2018 collapsed. Now, I want to do a quick test here. Suppose that you are a board member. The company that was controlling the bridge at the time was a company called ASPI. And actually, we know, thanks to an investigation, we know that in 2010, at a board meeting, the risk of the bridge was actually discussed. There was a note that was saying, there is this bridge, there is this construction defects. This is basically everything I told you up to now, except the fact that collapse was told there. And just in case, in 2013, the controlling company of ASPI, which was a publicly traded company called Atlantia, actually had a catalog of risk because enterprise risk management entered into corporate governance. So they decided to have a catalog of risk. And this bridge was listed as risk of collapse due to delay in maintenance interventions. So the fact that 5 years later collapsed is not really a big surprise. Now I have the test for you, and the test is, suppose that you are a board member, and I let you choose, are you a member of the subsidiary or the controlling, you pick, what should you have done? Okay, so of course with the benefit of hindsight it's easy, but think about at the time. And when I ask this question, should, of course, I need to specify what is the perspective I take. Should I take the immoral obligation? I should take the moral or immoral, depending on your point of view, obligation of maximizing shareholders' value? Should I think about my own career incentive? What should I think? So I think it's pretty unquestionable that from a moral obligation, you should raise hell. You should tell people this is a danger, and you should basically force a change because it's a major risk. I'm sorry to report that if you're looking from a shareholder value maximization perspective, the answer is more in doubt. Why? Because this bridge actually belonged to the state, was privatized the management of the motorways, not the property, and this concession was ending in 2033. So if you're really trying to maximize shareholders' value, you're trying to minimize the expenses in maintenance Of course, subject to you don't have a collapse, but you're trying to get the first order condition, sometimes you get it wrong. 43 people die, as we say, collateral damage. But now, the most problematic thing from a career perspective, what should you have done? And I'm sorry to report that you should silently resign. Because we actually have a board member who is honest enough to report, and he was the one that reported later that at an induction meeting, the discussion of this risk of this bridge came out. And he said, I didn't say anything, and I got worried. And particularly got worried because he asked the fundamental question, who certifies whether the board will stand or not? And the answer is, we self-certify that. And so he said either the bridge closed or an outsider needs to certify. However, what did he do? I should have made a fuss, I quote his interview, but I didn't. Maybe because I care about my job. I didn't do anything, and that's my great regret. And of course, actually, at least he is honest enough to say when the bridge collapsed, he really felt responsibility, and he does say, I feel morally responsible. Morally responsible, but the incentives were not there. The incentive was not to make a fuss and get off the board, not to have legal responsibility, but let the things go the way they're supposed to go. Now, you think this is Italy, everything is screwed up. In Italy, it's a beautiful country, but we're not here to take lesson on corporate governance from Italy. However, I wish that was true. So what you see there is the leftover of a 737 MAX, a Boeing 737 MAX. Not the first, the second that collapsed. Now, why did it collapse? Because Boeing decided to cut corner on the production of a new 737 and not tell the FAA and the pilot and the airline companies that the pilots needed retraining, because in order to stabilize the plane, they had an automatic stabilization mechanism that came into place, and if you didn't understand what was going on, you had 30 seconds to realize what was going on, otherwise you were dead. And so when the first actually plane went down, they blamed the pilot. Why? Because in Indonesia, it's easy blaming the pilot in Indonesia. But the pilot, the poor pilot, who died, by the way, in 30 seconds were not able to figure out something was not told. And what is scary is that apparently from litigation we know that the Boeing board knew about the fact that there was some problem, and they insisted in saying the plane is fine, and they continue flying the plane until a second plane collapsed. And after the second plane collapsed, they insisted it was still safe, the FAA insisted it was safe. Fortunately, there are other aviation authorities, started with China, then Europe, then every basically other aviation authority in the world decided that they didn't want to have this plane fly, and eventually even the FAA decided that maybe it was not safe to have them fly. Now, what is the total bill for this? Only 346 people. Why did I say only? Because the Germans do it on a large scale. When you produce Volkswagen, they actually had a defeat device that was underestimating on purpose the amount of pollution that were issuing and emitting. And when you look at the extra amount that was emitted and multiplied by the number of cars in circulation, you look at the concentration of this stuff, the estimates we're talking about at least 1,000 people die as a result of this illegal emission. Then you go to Exxon. Exxon in 1978, the board of Exxon was told by some top scientists that there is a thing called climate change and is caused by burning fossil fuel. So in 1978, the board of Exxon knew that perfectly well, but in the mid-90s decided to start a campaign to say otherwise. And since Oliver has worked very much on prisons, let's talk about prisons. And what you know that in the United States there are prisons that are private, and they are also advertised as a very efficient thing to have private prison. Little detail people know, as a result of private prison, we have intense lobbying on the extent of sentencing. So there was a case in the United States of a couple of judges that really got paid off to extend juvenile sentences. you heard it correctly, extend juvenile sentences. Now, the good news is these guys got caught and they are in jail themselves, so that's good. However, who's not going to jail are all the people who lobby systematically for extension of sentencing. And we know from the literature this extension works very well and works to extend the number of the years that people spend in prison. Why? To increase demand for the product. So this is really an issue that I would call the banality of corporate evil. And why? Because consider sort of the Boeing case, where 346 people die. You're hard-pressed to find who is the main villain here. So certainly there is a Boeing CEO that at the time of the design really put an enormous pressure for the product to come to fruition and come to market. And as a result, they might have cut some corners. There are engineers who find cheaper to deal with the construction defect. There are the Boeing's regulator, the FAA, who trusted Boeing too much. And finally, there is the board that at the time of the first disaster decided that they should keep flying the plane. Now, I claim that probably all of them are responsible, but I have to say, with all due respect for my colleague and friend, Gene Farmer, that really there is not really expostly settling up. If you look at the social sanction, you probably don't know who is this guy. It's Jim McCurney. He was the CEO of Boeing who cut corners, and he lives happily in Chicago. In fact, he's on the board of Northwestern University, and before was the chairman of the board. So clearly no social sanction. And if you don't know, Americans will recognize her. Who is this lady? This lady is Carolyn Kennedy. She was on the board of Boeing, and she only resigned at the beginning of 2020, I think, in order to, no, 2021. Why? Because she was named by Biden ambassador to Australia. Now, there was a time in which this was really a punishment because Australia was a penal colony, but I don't think that's what Biden meant as a punishment to be sent there. So, of course, when you see all this, people, economists say, oh, but that's obvious. These are externalities. Where is the government? And first of all, maybe because I come from Chicago, I said it's good that you ask this question, because some of my colleagues forget to ask these questions. But it's important to realize that you need an effective government to regulate, enforce, and punish. And that self-regulation does not work, and reputational incentives are not enough. But the point I want to underline is that the government very often doesn't work because companies ensure that the company doesn't work. So remember the Italian company with the bridge that was self-regulated? At some point, the Italian government introduced a regulator, and the company lobbied very effectively to be exempted, grandfathered from regulation. So this is not the government being not having thought of this, is the company altering the situation. And then you go down to Boeing. Boeing had captured the entire FAA. In fact, some safety procedure that should have been done by the FAA decided to delegate that to Boeing directly. And Volkswagen, Angela Merkel came to the United States lobbying for Volkswagen. So the German government was the lobbying for the Volkswagen organization, not to mention the private prisons with all lobbying legislators and judges. So I have to admit that this is a systemic problem, and the real villain is a system that pushes companies to corrupt our government, pollute our environment, and jeopardize our safety. And the irony of all of this is that we own most of them. We are the ultimate responsible because we are enjoying the proceeds through our ETF and index funds, the proceeds of all this. And these crimes are perpetrated by our representative, allegedly to defend our interests. That's the ultimate irony. And so is the problem capitalism itself? Now, the great intuition of Adam Smith was that the capitalist system was able to transform the pursuit of self-interest into something that looked like a social good, was able to transform private vices into public virtues. And as economists, we know this was formalized by Debray under certain assumptions, etc. But now we see an increasing number of cases in which it seems kind of the opposite. It seems that private virtues are transformed into public vices, in which very decent people end up committing or being responsible or producing as a result of a lot of negative outcome. So I think it's legitimate to say that is the problem capitalism itself or the way we have implemented it? And so what we claim is that there are several forces that have caused a amoral drift in companies' behavior. So what are these causes? I think that in the book we're writing, we're going to go in more details, but for the purpose of this talk, let me focus on what we think at the moment are the biggest ones. So one issue is high power incentives. Now, high power incentive combined with limited liability leads managers to take excessive risk from a social point of view. This is not a new idea, it's very well known in finance. However, applies way outside of the finance realm. So think about under-maintaining a bridge. This is clearly an example of risk-taking, as it is to skip safety for a plane and other examples of this nature. And what is interesting is this problem has increased dramatically. So if you look at the late 60s, early 70s, the vast majority of the compensation of CEOs of large companies was fixed. There was very little equity component to it. And then in the 1980s started to increase, and now the vast majority of the compensation is equity-based. And if that was not enough, the compensation of the CEO on average, in real terms, skyrocket. And to the extent your position is at stake, then of course you have a very high pay-per-performance sensitivity, because if I can be promoted to get and win $10 million a year, I'm willing to do a lot of things to make it happen. And second is a bit of the nature of the corporate contract. So let's start from the usual example of an entrepreneur that starts a company. An entrepreneur, we know entrepreneurs maximize utility, not profits. And when multiple investors create a company, can they choose to do the same? So imagine that I start a company and I'm a very devout Christian and I want to actually close my shop on Sunday. And if you want a real-world example, Chick-fil-A is an example. If you travel through American motorways, is the only thing that you can eat and not get food poison. So you know that it's important not to travel on Sunday because they close on Sunday. And I say that is very unprofitable for them to close on Sunday. Okay, it's very unprofitable. They do it because they're Christian and they pose values before value. Now, they happen to be a family, they're all very devout Christians, so they all agree and nobody challenges. However, imagine that one of the kids decides not to be Christian anymore, he can sue the company, and then I will get an education from all the lawyers in the room. But my understanding is that if the managers are unwilling to lie, of course they're devout Christian, they will not lie. If you are willing to lie and say that I don't open on Sunday because this maximizes the long-term value of shareholders, you get away with that. But if you say, actually, I close it because it's wrong to work on Sunday, at least to my religion, that's hypothetical, of course, they are going to lose. And why? Because of the way the fiduciary duty has been interpreted, at least in the United States. And I know that in Europe it's different, and I think tomorrow we're going to discuss many of these differences. So in Delaware, the legal norm has evolved into the idea that you should maximize shareholder value. Now, as I said, if you lie, you can get away with anything. But that's not enough, because not only the manager should maximize shareholders' value, even if the manager will say, okay, let's put this to a vote to hear what the shareholders want. Now, if you are a fund manager and you are somewhat interested in belonging to an ERISA plan, ERISA requires to act in the interest of the beneficiary. And you said, oh, that's fine, because the interest of the beneficiary can also be the moral value of the beneficiary. Except that there is the Supreme Court of the United States that recently said, no, we should interpret interest as financial interest. So, long story short, if you are managed under ERISA, you have to vote for something that maximizes shareholders' value. Now, of course, company lies, can all the things, etc. But imagine that you manage money of all Christian people who want to close on Sunday. There is a vote to close on Sunday. You cannot vote what your investors want because this will violate fiduciary duty. And this applies de facto also outside of ERISA. And I was in a debate a few years back with Larry Fink from BlackRock, and he told me at the debate, he said, I feel that I need to satisfy the fiduciary duty, which is to maximize the shareholders' value. So he cannot deviate in the vote, and we're going to hear tomorrow from Sandy whether that was the case. Okay? So, if that was not enough, I think that the takeover pressure will push company to behave in that way. So imagine that you are running your company and closing on Sunday because you think that that's the right thing to do. A raider will come along and make a takeover offer, and even if the shareholders care about their social objective, if they're sufficiently small, they will tender in the takeover bid, and short of having a mandatory shareholder vote, you can't get around that. But at the mandatory shareholder vote, you have the fiduciary duty of institutional investors that will force you to vote in that. So long story short, you're going to go straight in that direction. Now, I want to be very clear here that when we talk about amoral, we're not talking necessarily immoral. So the fact that we have this moral drift sometimes is good because we don't share some values of other people. So, for example, Becker a long time ago shows that if you pursue profit maximization, you tend to reduce the amount of discrimination due to racism, and that's clearly a good thing. So that's not always negative, but in many situations can be negative. Now, the question, of course, is what to do about it. And let me be very clear here, because generally there are two basically perspectives. When you see this, a lot of people have pointed out, we're not the first one, and tomorrow we're going to discuss a lot of this alternative view, but there are two main sort of line of thinking. One is that companies can be nudged or convinced to do the right thing because of some moral pressure, or the alternative is that we know what companies should do, and then we should legislate from a point of view of what the moral or social objective of companies are. And if you like any of these two extremes, you're going to be disappointed, because we actually believe in a free market system in which people can choose, but we would like the free market system to reflect the value of society and not be forced into something else. And so we're trying to have a minimum level of intervention that will deliver the result. So the first one is, and some strange coming from somebody from Chicago, but maybe we should limit high power incentive schemes. So if I'm a terrible soccer player, and if somebody were put him on a field and say, there is $100 million at stake if you win this game, the first thing I will do is I will go after somebody else's legs. And now you say this is the Italian way of playing soccer anyway. But I think that I will not stand a chance to win following the rules. So either I go after somebody else's legs, or I play with my hands. Now you British know what it means. Or you buy the referee. That's the old-fashioned way to do it. I will walk on every margin except the one of playing better, because I'm hopeless. And so the question is, to what extent high-power incentive scheme have a social cost? And if you are a strawberry picker, and there is a beautiful paper by Oriana Bandiera showing that if you are a strawberry picker and you're paid straight incentive contracts, actually you work harder. Why? Because you're super monitored, super controlled, blah, 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 and they don't have a lot of margins to deviate. Actually, when you give a little bit of margin to deviate, you have relative performance evaluation. Immediately, strawberry pickers trying to collude to lower the benchmark, so they are paying more. Okay, so this is saying that unless we have full control of the environment, paying actually manager a lot for their performance will lead to probably more cheating, more distortion, and more action that we don't like. And actually, I challenge this distinguished audience to give me the best evidence of high power incentive scheme at the CEO level producing very good results. And I can show you on the other side a lot of papers showing a high power incentive scheme lead to more pollution, more fraud, more everything. Now, of course, I'm not saying that we should abolish a high power incentive scheme, but you know, the US system actually favors, from a tax point of view, incentive-based compensation. We should think about whether this is the right thing to do. The second aspect is to do a small but important shift in the way we think about fiduciary duty. So the current system is to interpret as maximize shareholders' value, even when shareholders have a different objective. And what we propose is simply that the fiduciary duty should be the act in the interest of the shareholders. And now, of course, you say, how do they know? I'm going to come back in a second. But I think establishing the principle is important. And that implies that if the shareholders want to sacrifice value for values, directors should oblige. And so should asset managers. So the key point here that we are pushing is this idea of shareholder democracy. And why do we think it's so important? For at least two reasons. Number one, when shareholders are well diversified, they internalize, not all, but some of the externalities that they impose. So if I'm lobbying very aggressively to distort the marketplace, I'm really hurting my competitors. And if you own both stocks, you end up being a loser for sure. And so universal ownership can address some of those issues, not all of them, because of course there are a lot of assets that are not traded, and there are consumers, there are workers, so not all externality will internalize. Now, in a paper with Eleonora and Sir Oliver, we also showed that if the majority of shareholders is slightly pro-social, not like Mother Teresa, but slightly pro-social, then if asked to vote, and then you say, why would they vote? I'm coming. But asked to vote, they will vote exactly like the social planner would vote. And the intuition is very simple, is because they bear a teeny tiny fraction of the cost, but the only state of the world in which their vote will matter is when they are pivotal, and when they are pivotal, can change the world. Imagine that you think about, I'm going to cast the vote that changed the way Exxon behave. There is a lot of social good you generate, and even if you are not that socially inclined, as long as you're not a pure selfish pig, you're going to vote for what is the right thing to do. Okay? Now, of course, you're going to tell me, wait a minute, if shareholder democracy is so great, why has it not worked so far? Number two, can shareholders really be consulted on every business matter? And number three, if they are consulted, will they vote? In the United States, 40% of the people don't vote for the presidential election. How can you possibly think they're going to vote for every stock they own, especially if they own a well-diversified index? Now, why shareholder democracy has not worked so far? And I studied this and I discovered the following fact. It's not recent because the SEC until recently have prevented any vote on social issues. So I can say that the SEC has been consistently on the wrong side of history for the last 70 years. So let me substantiate this pretty bold claim. In 1952, in one of the first proxy issues, some shareholders asked to put on the ballot of Greyhound Corporation, is a bus company, to desegregate buses. Now, before you tell me that segregation was a matter of state law and they couldn't change it, you're wrong, because in interstate buses, there is the interstate clause, and legislation at the state level could not have an effect on the interstate. So if I have a bus going from Chicago to Alabama, even if Alabama at the time has segregated buses, I can choose to have the bus not segregated from Chicago to Montgomery, Alabama. The SEC said, this is a matter of social issue, is not a proper subject for a shareholder discussion. In 1970, some entrepreneurial law student at Yale actually inherited some Dow Chemical shares and proposed at the shareholder meeting to ask the company not to sell the infamous Agent Orange to somebody who might use it against human beings. For those of you who are too young to remember the awful Vietnam War, this was the US government, okay? So they were asking the Dow Chemical not to sell, and the SEC actually denied the right to have that vote. Now, the irony of this is that in a defense, the management of Dow Chemical said, oh, we are actually not making any profit out of the production of Agent Orange. We are actually doing out of patriotism. In 1992, the shareholders of Cracker Barrel voted to ask the company to abolish any discrimination on sexual orientation because that fired a couple of transgender. And the SEC said, that's not a matter for the shareholder to discuss, that's a matter for management. And so a vote did not take place. And last but not least, Walmart in 2014, actually, Trinity Church, that owns many shares in Walmart, asked to put on the ballot the idea that maybe you don't want to sell assault-style rifles in every department store in the country. And they said that's a marketing strategy that is the sole prerogative of the company directors. You cannot put that on the ballot. Now, you ask why we're not interested in voting? Because we cannot vote on anything that matters, basically. The only vote you have is to have the closest thing to a Soviet election in the Western world, because you have some incumbents that propose the next slate as many seats as positions, so you can vote yes or abstain. And you know what? Even if the majority abstain, you're co-opted on the board anyway. So your vote is completely irrelevant, but it's not irrelevant because should be irrelevant, is because they made it irrelevant. And now the question is, will shareholder vote? And of course, voting on every issue is very costly, especially for diversified shareholders. But wait a minute, isn't that true also of democracy? Do we vote on everything? Now, in Switzerland they do, but in most countries they don't vote on every issue. There is a thing called delegated democracy, okay? We vote for parties and we hope that, or representatives, we hope that they have an ideology that will vote as we will vote in Congress. And in the same way, shareholder democracy can work. Institutional investors can either elicit the shareholder preferences or offer funds with a predetermined voting strategy, or even better, pass through the voting right with some guidelines to choose from. So I can choose the Catholic faith guideline, and Dimitri can choose, there is not an Orthodox faith guideline, but there is an environmental guideline, and so on and so forth. Everybody can choose the guideline, and so I don't need to read 500 proxy statements a year. I can simply delegate. But then the question is, what really are going to vote on? Because the point is, many of the issues, like how you design a plane or want to do maintenance, they really contain a lot of information that is at the center of the company comparative advantage. We cannot put everything to a vote because in a business world, your informational advantage is part of your business value. However, I think that there is a difference between business strategy and impacting other people in your decision about externality. So the most, I think, innovative and big controversial proposal that we have is that in large corporation, to be defined, here I put a number, but that's not, don't fix the number, we propose a creation of, I find it difficult to pronounce it, but corporate ombudsman. I actually prefer to say tribunus plebby, because this is what it is a representative of the plebby, which is us, in the board of directors, whose responsibility is to force a public vote when large externalities are present. So now, what we're working on is how to create the right incentives for these people not to be co-opted by the board, because I've spent enough time on corporate boards to know that if you are a single one, there are only two solutions: either you comply, i.e. you shut up, or you leave. There is nothing in between. So how can you possibly create an alternative? The first one is you want these people to be elected by institutional investors and sit on the board without voting rights, pay like board members but no variable component, and they have the responsibility to ensure that if a decision has large externality of social impact, it should be voted at the shareholder meeting. So if Exxon decide to launch a campaign of disinformation on climate change, the tribunals will say, I want this to be voted in front of the shareholders. So I'm not saying you shouldn't do it, I want the shareholders to agree. And then I want to see who publicly is going to vote in favor of that. And of course we need to create some liability if they don't do that, otherwise they might slack off. Now, you're going to say, wait a minute, but today's world, public equity is an endangered species. All the world is controlled by private equity. So if we exclude private equity, we're not really changing capitalism, because private equity is capitalism on steroids. And so imagine that the private prison I was discussing earlier is owned by KKR. KKR might be perfectly happy to have longer sentences. This is the business strategy, and not everybody cares about others. And we don't assume it, and I think it's good to consider the positive. Maybe they care deeply, I don't know. But yet, the point is, if they are forced to vote publicly to support lobbying for longer sentences, I think that even if KKR, I think that Colbert is dead, but Kravis is still around, Eric Kravis doesn't like it, he's probably going to vote not to do it, because its own investors will revolt. Because now we can make the investors in KKR responsible for endorsing the strategy. And to this point, I think we want that maybe the tribunals here is elected by the ultimate investor in the KKR rather than KKR himself. Of course, there is still a tension between shareholders and stakeholders. So what we've done so far is we empower shareholders to make a difference. However, this does not fix all the problems, of course. In particular, there is the risk of collusion in the product market, lobbying to increase corporate power at the expense of workers, lobbying to shift the taxes on consumers, and so on and so forth. However, we think that when you force a vote on this issue, really, Brandeis is right here, the sunlight is the best disinfectant. I think that these practices will not resist very much if you have sunlight. And the knowledge will bring, in our view, a response from a regulatory response and from a democratic response. So, concluding, because I want to leave ample time for questions, there is no doubt that capitalism has brought enormous prosperity to this country and to the world at large. And nevertheless, in recent years, we have seen a very different breed of capitalism. When Adam Smith conceived the free market economy, there were very, very few large corporations. And the ones that they existed were hated by Adam Smith. The East India Company was a bad example that Adam Smith was repeating all over again. Now, of course, it's inconceivable to think today about a capitalism without corporate capitalism. However, I think that we are witnessing a drift that has taken place most in the last 40 or 50 years that has made the capitalism we experience much more amoral than most of us will want. And we think that without changing the incentives inside the corporation, this power cannot be curbed. And what I presented here, some ideas Sir Oliver and I are working on. But I think that what I want you to focus on is not necessarily our solution. I would love to debate them tomorrow, the solution, but I want everybody to focus on the problem, because the problem is real. And while I cannot be certain 100% that all our solutions are right, I'm 100% certain that the problem is real. And without the awareness of the profession, there is no possibility for a change. Thank you.
So thank you very much, Luigi, for this fascinating presentation. So we'll now open the floor for questions. 1 second. I have to say a few things first. So first of all, please keep your questions short and ending with a question mark. Given that we're having an academic conference tomorrow, during which we'll get some of the finer points of today's lecture, let us try to keep today's questions broad and onto the big picture. For the same reason, because of the conference tomorrow, I would like to encourage and I will prioritize questions by students who will not be at the conference tomorrow. Let me say finally, for online questions, please use the Q&A feature at the top left of your screen, and we will try to answer as many as possible. If you're in the room, please do wait for the microphone to get to you, and let us know your name and affiliation before you start asking your question. So, okay, so let us go ahead. Let us take some questions from the audience first. Yes, please.
Thank you. Good evening, Professor. I'm Shaurya Bansal. I am a MSc student at the LSE. I study economics. Thank you for the talk. I had a few questions regarding some of the themes that you raised. When you talk about the shareholders not being able to vote on social issues, is there, probably I missed that part, but is there an implicit assumption that they would have voted in the direction that you want them to vote? So for example, disaggregation. So we're implicitly assuming that the larger society will do what we think is beneficial with the advantage of hindsight. The second thing is, I found it interesting that you mentioned arrow a couple of times, but if you allow such processes to be taken over by the same political process that we are trying to escape from by going to private markets, will that not raise the same problems? And lastly, you also mentioned Atmosphere a couple of times. So one thing that I remembered is one of the quotes which says that be wary of those businessmen who want to affect the business for the public good. So is that their incentives they may have incentives to raise their issues, but they can just say that this is in the national interest or you should do this because we really believe in this. So going back to the Christian values or whatever, they may really believe in their values, but they may be just co-opting the political process. So that's a few questions I have. Thank you.
Yeah, so I think that, thank you, those are excellent questions. Let me try to answer them all. So the first one is, did I expect them to vote, quote unquote, the right way? No. I think that probably they would have lost in 1952. I think eventually, if I remember correctly, they did have a vote on the Dow Chemical, and they lost. However, I think my justification is the reason why people have no interest in their voting right is because they're never given a choice. The moment they will have a choice, they might make a difference in the long term. And it's like saying, there is no point in voting for a minority party because it's not going to be elected, it's not going to be run the government, but a minority party eventually can turn into a majority. And let me tell you something interesting is that in the last year, at the shareholder meeting, both of Moderna and Pfizer, there was a proposal by the shareholders to share the vaccines, the COVID vaccines for free with all the African content. And I don't remember the exact number, but roughly 22 or 23% of the shareholders voted in favor, okay? And Sandy might correct me, but I think that neither BlackRock nor Vanguard or Fidelity or State Street voted in favor. So it's pretty quickly to say that had they voted in favor, they would have made a difference. Okay, so sometimes we are pretty close to make a difference. But at the end of the day, I don't necessarily want to impose my values. This is what I think is nice of this, is I don't want to impose my values to the shareholders. I want the shareholders to express their value. This is the ultimate freedom. And what we are claiming is the current system basically say you can express any desire you want as long as it is shareholders' value maximization. And that is not freedom. Okay? And if they get the wrong answer, from my point of view, that be it. And it says how many times the outcome of the election is wrong by my standards? Almost all the time. So, but that's part of what democracy is about. I think that it is a more serious issue that certainly the political system has not worked so well. So why do we want to import some of that? And I think that actually I have a slightly different view of this because I do believe that referenda have worked remarkably well. And I know I'm Britain and everybody talks about Brexit, and Brexit is a disaster. But Brexit is the example of a country that does not have a tradition of doing referenda and made a stupid question, because if I ask you to choose between the current system and a dream, you're always going to vote for the dream. And I'm sorry that I report for the second time Italy in a positive domain, but Italy got this right. Italy is a Catholic country. In 1981 had a referendum on abortion, and it was not a referendum between an ideal thing, it was a referendum between a law that was approved and no abortion right. And 65% of a Catholic country voted to have an abortion right. Most importantly, because you can be on either side of the issue. The issue was eliminated from the political system. We have a lot of other problems in Italy, but not that one. Completely eliminated from discussion. Why? Because the people have spoken. And so today you see people in great tension. At the end of the day, let the shareholder decide is like a referendum. And once they decide, close and let's move on.
Yeah, please go ahead.
Thank you very much. Mikhail Mikhov, student of political economy here at LSE, and thank you for your attendance at the conference on Saturday as well. That was great. My question is, these are excellent proposals, but by enacting them, are we not privatizing democracy? I believe 20 years ago, Fareed Zakaria raised this problem that we were maybe tending towards an oligarchic system, at least in the United States, where only the wealthy have the power to buy the policies they prefer. And in that sense, the shareholders of these corporations, yes, even I have invested in index funds and so on, but they will be mostly the capital owners. And so doesn't that absolve the government of a part of its responsibility to regulate if we put the power of regulation in the hands of these shareholders? And is there room for a broader corporatist solution? And I'm using corporatism here as negotiations between the shareholders, workers, and the state. Thank you.
So, excellent question. In fact, excellent questions, because I would like to distinguish your question into two. The first one is, if we do something a little bit better at the corporate level, are we making less likely that the government will fix itself? I think it's a legitimate position. It reminds me of many of the communists in the old days that said we don't want the workers to improve their living standards, because if they improve the living standard, we delay the moment of the revolution. And it seems a bit like a self-defeating strategy from my point of view, but anybody is free to make their own conclusion. What is more important, because this is a very important question that has been raised many times, is this system too plutocratic? Because we give, at the end of the day, shareholders a double power, okay? And the answer is no, for two reasons. First of all, this is private provision of public goods. I think that this building is named after...
I can tell you who the number anyway.
There is the Marshall building,
Yes.
over there. It's probably donated by Mr. Marshall,
yes.
that provided a public good with his own money. Do you call that a plutocracy? Maybe, but it's still better than not having the building. And I think we should encourage corporations to do private provision of public good. But more importantly, I think that there is a fundamental distinction between the shareholders and the other stakeholders. And the fact that the other stakeholders have a much more effective exit option to pressure the company, and the shareholders much less so, because when they sell at a discount, and so they pay the cost of what they're doing. And so certainly for customers can really, I think, penalize and influence the corporation very effectively, and we're seeing a lot of companies that don't dare to do something because of fear of consumers. When Target started to put some transgender stuff in the store, there was a revolt of consumers, and they stopped doing that. So in a sense, in today's world, I fear the consumers have too much power, not too little power. And for workers, it's a little bit more delicate, because I think that when it comes to higher level workers, I think those are incredibly influential. So think about the entire Disney fight. I don't think that the workers at Disney World in Florida care about that issue very much, where they created in California who wanted a certain direction of the company in Florida. And that's an interesting question. I don't know why they call plutocracy or something, that some workers in California might overturn a legitimate decision that I don't agree with, but is a legitimate decision of a legitimately elected Congress of Florida. So in that case, maybe it's too much power to the creative of Disney. But I think that when it comes to low-level workers, I think that maybe we should have more of a, if you want, agree-upon decision. In that case, if you have an effective union, the union will bargain to get what they want. So with the power consumers and an effective union, I think that giving all the power to shareholders will deliver the right outcome, not the plutocratic outcome. Yeah, please.
Madik Batkap, independent researcher. I think the issues that you've so clearly identified and so trenchantly done in what I must say is a rather humorous way as well this evening, which is much appreciated, are much more deep-seated than you have indicated. I do not think there is such a thing as shareholder democracy. I think it is a contradiction in terms. We have looked at a society which in the Western world, in the developed world, we've tended towards one person, one vote. Now, the problem with capitalism is the corporate structure, that we have £1 or $1, one vote. And in fact, the system of governance for companies is the purest form of plutocracy, to use your word, that has ever existed. And by definition, we do not live...
I'm waiting for the question, Mark.
Is there a question? And there is a question, right? There is a question. But I want to put the context, because ultimately I think the reform required is much more fundamental. There are two parts of a company: the capital and the employees. And the question is whether it should be the employees that have the vote at the annual general meeting and not the company shareholders. Because if you just have the company shareholders, they're probably just another company further down the line. And if this gentleman has his investments in any number of funds, he won't get to decide. It'll be the board of the company that's running the assets that gets to decide. So do you not think there should be a much more fundamental look, with votes being by the employees of large companies, not by the shareholders?
So what is interesting is one of the examples I presented, and sorry for not going into all the details, but is Volkswagen. Volkswagen, as you know, is part of the German system of co-determination, in which half of the board is represented by the unions. But in addition, the state of Lower Saxony owns like 20% in Volkswagen, so they appoint their own representative that historically they always voted with the union. So Volkswagen is the ultimate example of a worker-run company, and I don't think the outcome has been so brilliant. In fact, I did not go into all the excruciating details about the fact that the union board member were corrupt by the remaining part of the board, offering actually salacious sex encounters in various places, and so on and so forth. So the governance of a stakeholder-based company is to be discussed. And by the way, only the German workers were represented. Because if you are a worker at the at the Volkswagen plant in South Carolina, they're not even unionized. And Volkswagen is fighting against unionization in South Carolina because what? Because they're American. Okay, so in a multinational society, it's very difficult to have stakeholders. For an idea that goes back to Henry Husman, is because they're so different in their interest. And the fights, if you think that the political fights are going to be big among shareholders, wait for the one among stakeholders.
There was, let's take, this question at this question at the back, well, please, the lady, with the...
Hi, I'm Ankita Majuri. I'm a financial markets economist with Capital Economics, hoping to be a student here next year. My question to you is regarding compensation. You've discussed that stock-based compensation can be one of the root causes of incentives that are against social good. Do you have thoughts on ESG-based compensation? It's also fine if you were to say, if you were to, let's say, agree with Professor Damodaran, who recently said that ESG really doesn't do so much. Overall, do you think ESG-based compensation can be a way to overcome a lot of these challenges we're experiencing?
So thank you for this question. I think that we need to first agree what ESG is, because I think that is a very multidimensional aspect, and everybody has their own version of ESG. And even when you look at ratings, they're not highly correlated because everybody measure ESG in different ways. And here is where I have to say I have a lot of hope for the pressure that comes bottom up of shareholders, consumers, and workers that want to keep companies accountable. I am much less convinced that these companies, out of their kind heart, will do wonderful things. And actually, I expected a question like this, so I have a couple of slides that I kept in reserve. Might not be here, but can you bring that? This is okay. Maybe not available.
Can we have the slides? Is that okay?
Yeah. Okay. So this is a company called Amgen. Is a pharmaceutical company, and as you can read, they have a beautiful ESG statement and say making a positive difference in the world is at the heart of what we do. And it goes beyond making vital medicines. We're all working to help build a better world by focusing on environmental, social, governance topics that matter to most of our businesses and to our stakeholders. What do you want more from this? Now, this is a random company. I random Google Amgen scandal. So number one, the FTC has sued, I think that's lost, but sued Amgen for trying to monopolize a drug market. And then Amgen is sued for concealing $10.7 billion in a tax bill from investors. Not to mention that it seems that they've hidden bad drug data and got away with that. And they have illegally marketed a cancer drug with kickbacks. And they settle $762 million in the single largest criminal and civil fraud settlement against the biotech company because they misbranded a drug and they violated a bunch of stuff. So I think that it's very important to keep company accountable. I don't think accountability can be self-referential. Exactly like the bridge, if you self-monitor, you're not monitoring enough, in the company is the same.
Okay, let me take this question again at the back with, please go ahead, and then we'll take some questions from the online audience.
Hello, I'm Theodora Margaritova from Bulgaria, and I'm doing my MSc in political economy here at the LSE. My question refers to the notion of pivotality, which you touched upon. Essentially, where all of our stakeholders, if they're given an increased amount of power, I would reckon that there would be some sort of interest to lobby some of these stakeholders. So I'm wondering whether, in fact, such a situation would be a violation of the notion of pivotality for some of these voters. Essentially, if I'm a voter that is not being lobbied, but I know that there is a very high probability of the majority being lobbied, then surely, this will be an issue. So my question is, in such a case, what measures would we take to avoid something like this? Would an ombudsman, as you mentioned, be enough, or do you expect other interventions to be needed? Thank you.
I think that, that's a very important question because at some level, if you think in a democracy, electoral campaigning is exactly lobbying for various outcomes. Now the question is, do we want to allow this unrestricted, and how costly this can be? Most importantly, we know that votes are incredibly concentrated into 3 institutional investors, and they are trying to do their best to shed that responsibility to the final investors. But I can see the risk of lobbying the institutional investors to change the system. Ironically, we have that today on steroids, because if you can convince, now it's impossible to convince her, but if you can convince Sandy Boss, you basically get whatever you want. She is the most powerful person in America. So I think she's lobbied very heavily by everybody, but in a sense is too much responsibility. That's the reason why she's trying to shed this to the ultimate voters. And one way to think about it is the beauty of democracy is, in order to get something passed, you need to convince, bribe, you use the term, the majority of the people. That's what the democracy is about. So that makes it awfully expensive to do that on a large scale. So that's what gives the resiliency of democracy at the political level, but also at the corporate level.
Let's take a couple of questions from the audience, from the online audience, and then we'll come back to the physical audience. So, Luigi, I will read you 2 questions, and you can decide how to address them. So, one is by Martin Kornju, who is a PhD candidate at Bonn. He says, do you see any responsibility on the side of credit investors, that is beyond equity investors? That's one question. The other question from Raj Tamodaram, what is the best current example of a major investor acting as universal investor?
Okay, so both are excellent questions. So, major investor acting as universal investor, actually, I was, maybe it's not a stunning example, but I was in Mexico recently and at a pension fund conference, and they just passed a law that reduced the fee to the mutual fund companies by 40%. And I said, wow, that's pretty courageous of a government to have this ability. I said, it's not like Mexico is the example of democracy in the world. So how is it possible? And you know, Carlos Slim is pretty influential. And by the way, he owns a pension fund, just in case you. So how can it not have an influence on the government? And the answer is, because he has a portfolio of companies. So it is a quid pro quo, and actually he does not know much in pension funds. So he lets the government pass on this, on that front, in order to get a favor on the other side. So that's not a good example of universal ownership, but this shows that if you own a lot, you reason a portfolio consideration. Who doesn't? And it says, if you are a rational investor, you have a portfolio of businesses, you look at your portfolio, you don't maximize one at a time. That would be counterintuitive. And the
other one is about credit investors.
The credit investor is very, very interesting because if you talk about small credit, I think that the market is quite competitive. I don't think that you make a difference. When it comes to very large loans, unfortunately, concentration has gone up tremendously. And so as a result, 1 or 2 key institutions can have a lot of role in determining the system. And with power, with monopoly power or market power comes responsibility. And so they are becoming much more responsible. So I think that if they want to shed some of their power by breaking up and becoming more competitive, we're happy to take away their responsibility. But as long as they're so concentrated, I think that they should be somehow responsible.
Thank you, Luigi. Okay, yes, please. Okay, please go ahead, yeah, and then we will go to the lady. Yeah, to the lady back there. Yeah, the gentleman here. Gentleman here first.
Thank you. Hi, Francesco Coppola, doing the Master in Econometrics here. I mean, the talk is called Reforming Capitalism, and I really appreciate and applaud the effort to do so within capitalist constraints, right? From a very decentralized point of view, with the shareholders voting on certain issues. But I have two questions. The first one is, you really focus on big companies, on large companies whose negative consequences for the environment and for a variety of social issues are evident. But I would argue that a lot of the negative consequences of the beautiful system of capitalism are local, produced by small and medium enterprises with very little institutional investors. In fact, some are completely family controlled. And among these enterprises, there is no culture of prioritizing social issues. Instead, they're just trying to maximize their own profits and whatever consequences comes from it, it's fine. So the two questions are, first of all, do you think that capitalism is going down a bad route because of mainly large companies? Do you not think it's a local and maybe a much smaller problem? And the second question is, if it is a smaller problem, or at least a problem that it dilutes in all localities, then isn't it easier to have a government that regulates deeply, despite the moral challenges of this, that deeply regulates the markets, such that even small companies are forced to follow social responsibility?
Thank you for the question, because clearly I wasn't clear enough in my speech. I do think that we need a government to regulate. And I think that when it comes to small companies, I'm not saying that the government is perfect, but at least small companies don't have the power to subvert the regulation. The problem is when it comes to large companies, you cannot say, oh, the government should do this, because their effective power is so large that they undermine the company. And my favorite small medium company in the United States is Chuck E. Cheese, that is like a small franchise in the United States. If you're Chuck E. Cheese and you do something wrong, I can assure you that the IRS is after you, the EPA is after you, and it's not that regulation is completely in effect in the United States. However, if you are DuPont, you have on your board the previous EPA chair. And then you have the local politician who actually lobby in your favor. You have the newspaper who are afraid to talk about what happened. Okay? One of the cases that I couldn't present because there were too many, but of DuPont dumping the PFOA, this substance in the Ohio River, producing a lot of damage and death, is that when people started to find out, they were shunned by the local community because there were pressure not to say anything against the large employer. So when you are a small company, you don't have all these things. I think that actually the Friedman assumption that you should maximize shareholder value given the constraint of the law is very legitimate when the constraint is an effective constraint and cannot be overturned by the companies. But the irony is that for large companies, that's not the case. And the irony is that, you know, I say when Stigler meets Friedman, because they were colleagues at Chicago, and in the same years, they wrote the famous 1970 piece by Milton Friedman, and in 71, George Stigler wrote his famous piece on regulatory capture. And so you have one guy that says you should maximize profits given rules, and the other guys say, we know that rules are changed to maximize profits, but the two pieces have never been put together.
There was someone in the... But yeah, please. Yeah, to the lady there in the back.
Good evening and thank you so much. It has been a very insightful talk today evening. My name is Meher and I am a Master of Public Administration student here at LSE doing social impact. So my question to you was that while we have spoken a little bit about responsibility and how horizontal a company should be with its shareholders as well as stakeholders, I wonder where that initial responsibility lies to like kickstart a change that is to happen in order for this to become the norm rather than an exception in the companies that we see. Like, is it something that the government would do, a policy problem, or is it something that happens more from like a bottom-up approach? What is your view on this?
I think that now we're going to the realm of activism rather than the area of economic studies. So I'm a little bit uncomfortable because I'm not an expert, and when I try, I fail miserably. So I think you shouldn't listen to my advice. But this said, I think that there is certainly an education on also your power. I think that most people are not aware that they can make a difference, and in part they're not aware because this issue are not debated, and there is a concerted effort because until this shareholder proposal were reaching 5%, everybody was relaxed. And then all of a sudden, when they start to reach 30%, then you see proposal in Congress to block the right to vote, to do all sort of things, because corporate America is terrified about the prospect that actually somebody else might give advice.
Let us take one maybe last question maybe.
Yeah, sure.
Okay, yes.
Thank you for the presentation. So I'm Jacopo. My question is twofold. The first one is kind of a follow-up on the previous question about the disaggregation of economic activity and the impact of smaller kind of enterprises. Because I think that, at least this is my personal view, and I think that anecdotal evidence is much stronger than actual papers on the subject. But like, at least in Italy, we have a lot of lobbying, and that passes through kind of unions or industry representatives where shareholder can't have a real impact on these kind of decisions, and where also, especially if you think about Confagricoltura and this kind of unions, you have a lot of smaller enterprises that are very impactful even on a very local level. So my question was how to deal about this kind of subject. And the other one is about thresholds effect. This tribus, this person, this ideal representative of the shareholders would be acting only if there's a large externality. What's the large externality? And are you not worried about threshold effects and management trying to go just under it? Thank you.
So I think you're absolutely right that not only in Italy, but also in the United States, association of categories, so the American Chamber of Commerce, is lobbying very heavily in name of some of its members. So, for example, in the great state of Illinois, where I live, the Supreme Court justices of Illinois are actually elected, and they do campaign. And the American Chamber of Commerce gave a substantial amount of financing to a candidate who got elected. And much of this financing was coming from State Farm, an insurance company. And as soon as this guy was elected, voted to overturn a lower decision, and it was a pivotal vote, that saved State Farm, I think, $2 billion. So I think that the risk is serious, and I think we need to have more transparency in these channels. So if I am the American Chamber of Commerce and I receive money from State Farm and I lobby heavily these particular justices, then this relationship should be linked and should be exposed and hopefully sanctioned in some way or another. In terms of the thresholds, I think that it is very important, in my view, for people to feel a sense of responsibility. So when I think about the bridge disaster, for example. There is today a debate in Italy if the ultimate owner, who was the Benetton family, is morally responsible or even legally responsible, but certainly morally responsible for what happened. And they say, you know, we just clipped dividends. We did nothing. Not sure it's true, but we clipped dividends. We had no responsibility whatsoever. And my question is, to what extent we are all Benetton? We don't live so lavishly like the Benetton, but still, we get the dividends of our companies, and we know what they do in the environment. And they said, oh, but it's not our responsibility. I have no power whatsoever, but I keep receiving the dividends. I think that if we want to change the world, we have to take responsibility, and I think that corporate democracy is the instrument to transform that awareness into action and into change.
Luigi, there's one more question from online that I'm tempted to ask you.
Please.
Okay, so given I have also a couple of minutes. So it's very broad, so it satisfies this criterion of very big picture. So the question is from Hawelti Kesete Haile. What can the Global South, which is the biggest victim of the system, do in this very necessary fight of reforming capitalism? I don't know if you want to comment on that.
That's an excellent question to which I probably don't have an excellent answer. But I think that, no, first of all, to the extent that the North cares at some level, I think that at least bringing some of this externality in the public domain will certainly help the South. Okay? Now, is that enough? No. But I think that one of the biggest problems of the South is that the government of many places in the South are corrupted, lobby, you pick the right term, by the North. And again, this is done by companies that we invest in and we see the proceeds. So the question is, if you really care about the South, what you have to care is about what are the oil companies doing in Africa? And that's part of what all this is about. Now, is that enough? No, but is a crucial step, because we cannot go and say, oh, you know, we do business in Africa by corrupting because that's the local habit. But it's not the local habit, it's what we exported that, okay? You know, one of the reasons why there is so much corruption in India is, sorry to say here in Britain, but the East India Company exported corruption in India. The major export there was that, okay? And of course there is the legacy. So I think unless we take responsibility of what we have done, I don't think we can change.
Thank you very much, Luigi. Okay, so let's bring this to a close. So it has been a great pleasure to have the opportunity to hear Luigi Zingales give the first the inaugural lecture, the inaugural Sir Oliver Hart lecture. It was a fascinating lecture, and I felt this way, and I think that all of us here feel the same way. So let us thank Luigi. Give him a